So do all stocks come back to their highs? The answer is absolutely not. I'm just going to put a list here on the screen, and some of these companies you know of by name: Alcoa, the Dow, Bank of America, J.C. Penney. I mean, we're talking all realms, not just financials, not just clothing. First Solar. I mean, there's one of the stocks that the government has been supporting in regards to solar energy and energy programs. AMD, that's the main, competitor of Intel. U.S. Steel. I mean, Steel. Citigroup, another bank. E-Trade Financial. American AIG, American International Group. Here's a company that the U.S. government bailed out to the tune of over $100 billion. Do they come back? Well, let's take a look at these charts. This right here, Alcoa, and I've circled where it bottomed here. Again, spring of '09. It bottomed down there, and I circled it at what, about $5.22. That's as low as it got. $5.22 is where it closed then. Where's it at today? $7.91. That's pretty good, from $5 to almost $8. That's a beautiful move up. But if you look on the left-hand side of the chart, at one point, not that long ago, it was $32. So if you bought it at 32 and you own it today for less than 8, you're down 75%. Now that's painful. Not all stocks do come back. Bank of America. Now this is a company, a bank that we all know, we use, we see it on every corner. They're not out of business. They're too big to fail. The U.S. government eyes. But take a look what I've circled down there. It went all the way down to $3 and a few pennies. $3. Now today it's back to $14.64. $3 to $14 is good, but on the left-hand side of the chart, it was at 37. It's not even back to half of what it was just a few years ago. J.C. Penney. Look at the volatility in this one. Look at the opportunity to make money. Way back in March of 2009, it was all the way down to $14 a share. It's down to $13 and change right now. So it's actually lower than it was in spring of '09, but look at all the opportunity to make money. It went all the way from $14 up to over $40, and now it's back to $13. This right here could be a gold mine from a trader's perspective. Here's another one, First Solar. We're in Arizona, so we know this one here, but First Solar, it went down all the way to, $105 a share in 2009 at the low, at the market low. Went back up to about $170 a share, and today it's trading at $46.75. It actually went down to less than $20 a share. Hit a high back there, 270, went all the way down to less than 20. That's what, a 90% move to the downside? That's huge, massive pain. But if you're trading properly using the cool trade philosophy, maybe it was a huge, massive opportunity for you. Let's do just a few more right here. AMD, again, major competitor to Intel, all the way down to $2. Today it's $3.72. So if you bought it at $2, you're happy. But it was all the way up to 10 at one point. Now it's down to $3.72. And then this one, U.S. Steel, symbol is X. March of '09 went all the way down to $17.69. Today it's at $17.17. So it hit a high of 140. Now it's down to 17. This is U.S. Steel. This isn't a fly-by-night company. It's not a company that's been around for just a few weeks. This is a company that's been around for decades. This is a company that a lot of people know, and they've owned stocks like that for decades. The idea of buying and holding a stock for years and years and years because they all come back just isn't true. Look at Citigroup. It was over $200 a share, went down and hit a low of 10. It's currently trading at 51. So if you bought it at 10 and now you own it at 51, you're very happy. But if you bought it at 200, or you even owned it while it was 200 and now it's at 50, you're down 75%. Either way, painful stuff. E-Trade. E-Trade went all the way down to $6 and change. Today it's at 15, but look at all that gyration. From $6 all the way up to $26. Now it's at 15, less than half of where it was. And one last one here, AIG. Again, bailed out by the U.S. government because they were too big to fail. It was all the way up there at $500 a share, went all the way down to $7 a share. Today it's at 48. So if you bought it at 7, you own it at 48, you're real happy. But if you owned it at any time when it was $500 a share, not so happy. So you get the point. Not all stocks go back up. And how low can a stock go? Well, there is no bottom to what your portfolio can do or how low a stock can go. A stock can go way down. A portfolio can become very small. We can get to the point where we're just discussed it. Or if you're in the market itself, they can play games with the indices. Let me just explain that to you. Now let's take a look at the Dow itself. One of the things that people don't realize is that when it comes to the market, they can actually play with the numbers, adjust it a little bit. So it may look like everything is fine and it goes from the bottom left to the top right. And as you look at this is a chart of the Dow Jones Industrial Average from 1900 to the present. So we're talking over 100 years of history right here. Big picture, bottom left, top right. So if you lived for the last 110 years and you had money in the market 110 years ago, you probably did very, very well. But let's look at it in some detail. First of all, I'm going to do this, and I want to make sure we understand this. Before the Dow even existed back in 1896, there was two guys, Charles Dow, and he and Mr. Jones got together and they co-founded a list of stocks that they wanted people to start to buy. This was a way for them to market stocks to the masses. So they created a list and they had people start to watch it. It became known as the Dow Jones Transportation Average, and later on became known as, it was just stocks that were in transportation. But then as it developed on, take a look at some of these names here: American Cotton and Oil, American Sugar, American Tobacco, Chicago Gas, Distilling and Cattle Feeding, General Electric, there's a name we recognize. We've got gas, we've got lead, we've got coal, we've got leather, we've got rubber. Think about where the country was over 100 years ago. That's where it was at. But the only name that you recognize is General Electric Company. As we take a look here, let's jump forward a little bit. This is 1928, just before the actual market crash that we talk about, right? The Depression. And as you look at this list right here, notice it's bigger. Instead of 10 stocks, it's now a larger list of stocks. And as you take a look, the only name that you'll recognize is General Electric. Now, meaning from the last list, you do see some other names like Chrysler, and you see Mack Truck, and you see other names here like Goodrich, and I see Sears and Roebuck, and I see U.S. Steel, right? Woolworth, I remember that. One of the, I'll call it the precursor to the dollar store, right? The old five and dime, as they used to call it. But General Electric is the only one that survived from the original list. I want to make that point very, very clear because these things were added. And then this was, by the way, the first time that you actually had 30 stocks in the Dow. So the Dow 30 only came into existence since 1928, and the only company that started right from the very, very beginning is General Electric. So where are we at today? And again, I'm going to go the Dow 30 as of 2012, but notice it says September 14th. They update this once a year. And as we take a look here, again, we do have General Electric right there in the center, but we have some other names. Now, Alcoa over there on the left-hand side, isn't that one of the charts that I just showed you where the stock is down severely? And then I see other names up here. I'm looking around the list right here, and I see different names like Johnson & Johnson, Chevron, Caterpillar, Boeing, Intel, Home Depot, Bank of America, very, very recognizable names. But I point out Alcoa to you, and maybe just below General Electric, Hewlett-Packard, because those stocks aren't as well performing. During this year's adjustment, and every year they can make adjustments to these stocks that are in the Dow, they might decide to take one out. Well, why would they take Alcoa out? Because it's not performing very well. So if they take that one out and replace it with another better performing stock, it'll make the index continue its rise from the bottom left to the top right. Now, that doesn't sound very fair, does it? But that's what they do. So when we look at the market, you don't own the market. You own individual stocks and companies. Now, some of you are actually now thinking to yourself, well, that's why I buy mutual funds. Well, mutual funds are a group of stocks, and the manager of that mutual fund has decided which ones they buy, at which quantity, and when they buy and when they sell, but it's still a group of individual stocks. Sometimes it's even less broad than the market itself. Now, I'm pointing this out to you because they can change those companies, they can change the game.